All right, good evening, everybody. This is Jeff Scott, and let me move my presentation over and get this going. And I got to change the custom slideshow. Nope, I want to. Oh well, I guess it doesn't like how I set this up. All right, so I guess we'll just show it off of this. Try one other thing. Hold on one second. I have two monitors. Well, it's not working, no big deal. Let me just expand this as much as I can, and we'll start using this slide. So again, welcome. It's Jeff Scott. It's September 14, 2014, and this is my weekend review. You can see one of our Navy frigates firing a missile, and like that missile, perhaps warning an offender, was this a shot by the bears across our bow to make us aware of its presence. Disclaimer, this is for education purposes only. Any recommendations are in the spirit of education, not investment advice. I'm a doctor, not a broker, and I am independent. No one is responsible for what I say, and no one is paying me to say anything about their products. I talk about the products I use, and I try and educate people so that they can use them and gain better results for them as well. I'm not just about the software tools. I'm very much about the people who've taught me how to trade, and I've learned from many folks, many of which are on this slide. And I've learned over the years from reading books, whether it's O'Neill or his disciples, Morales and Katcher, whether it's live meetings with Ian Woodward and Ron Brown, live meetings and reading books from Alexander Elder and Carey, or John Person, a great book, The Green Book, Mastering the Stock Market, a new book, and also a lot of discussion with my buddy George Lee. Other books that I've read are included here in some of the websites that I have frequented, although I need to update that. I clear my desktop when I do this because I don't want the vast number of programs that I have to be a distraction. Reality is, if I was going to Australia for 3 weeks and I could only bring a few programs like I'm going to be doing soon, I'd bring a small computer with TradeStation and Thinkorswim so I can trade, Genesis, which is my real-time monitoring platform, and then HGSI, EdgeRater, maybe Magenta Trader, although I can use, or Best Choice Software, two excellent seasonality programs, or I can do the same now in EdgeRater and MarketSmith. That's all that I need for my trading. I always talk about this picture here. Those that have been here before probably getting tired of it. But reality is, this is the most important thing that I'm going to do today, is understand where this market is, because if I think the market is rolling over, I am not going to be loading the boat for bear. And I hope you're not either. On the other hand, if the market is rolling over, I might be loading it up for a bear, and not to bear meaning everything I can buy. And you know, I keep talking about this little red circle, and we poke our heads into it, and before we roll over, we pop right back up. Now you notice the further you get down from this peak here, the further distance you have to make it up. One of these days, we're going to drop out of this circle, and we're going to head down into a major correction. Maybe that day is here. I'm a lot more nervous than I was last week, and if you're very bullish, then you probably had some pain last week. We follow a number of surrogate indicators here. One of the surrogate indicators that I follow is what I call the canaries. And the canaries are a number of big companies, NASDAQ 100 leaders, and you could see that they have pulled back, which is my basic chart function, calendars, 8-day exponential in purple, 1750 and 200 simple in red, traditional volume with a couple different moving averages on it, and you could see big run up after canaries pulled back in March, bottom in May, early June, and then we had a big run up, but they've now pulled back, sort of a wedging here, and are right on the 17. So I think they're at pretty critical support, and a break below the 17 might bring them all the way down to the 50-day moving average, which will be some pain in the market. Now we have other perhaps more demonstrative of the market as a whole, not this small segment here. And they all look the same. Here's a LLUR list we put together at the March Palos Verdes meeting, and you could see that it ran up sideways, corrected here. I guess that would be in August, and now it's back up, but it too is wedging and broke below the 8 and is sitting right above the 17-day simple average. I think that's a pretty critical place to hold, and if it doesn't hold, then I'll be looking for the 50-day as a target and potentially the 200, a substantial pullback. Lastly are my Florida Summit LLURs, and you see the same pattern, pulling back, breaking below the 17-day, next target 50-day moving average. Now, a pullback to the 50-day moving average, which we will look at on the indices, is not the end of the world. We just want to make sure we don't get a bigger pullback. Those that are fans of Ian know that the vast majority of pullbacks are less than 7 to 8%. And when you get beyond that, you need to be out of the market or fully protected, because you have there's no great answer to how far we're going to go. But if most will hold the 8% number. What is the impact of rising rates? Well, I think we all know that that's problematic for the market. Now, on the left-hand box, this is a monthly picture of the TNX.X, which is a 10-year Treasury yield index, going back to 85. And you could see we've been in this great period of time despite some aberrations of a falling interest rate. No shocker, I don't have a mortgage anymore. My first mortgage I took in 1989 was at 13% interest rates, and the last one I paid off was about 3%. So interest rates have fallen nicely, and during that period of time we can see in yellow the S&P 500 had run up. Now, interestingly, despite the fact that interest rates had risen some over the last many months, the market continued to go higher. Now let's look at the last 18 months specifically. And that's what you could see here on a daily chart. Actually, it's not even about 16 months. And what you can see is that the interest rates have been pulling back over this period of time, and markets have continued to go up. But the question is, now that the interest rates have turned up, are we going to see the markets hiccup? I would expect that in periods of time where interest rates spike, that the market pulls back. Interest rates spike, market pull back. Interest rate spikes, the markets pull back. And we're getting to a point where one might be concerned that interest rates are going to rise. More to come later. What about the dollar? I've talked about here several times. Talk a lot about with John Person about whether he looks back longer than I look back, and he looks back here to 2009, 2010, even 2011, and this spike has really not taken out the last couple of spikes. But the dollar is rising, and if you go back here, when the dollar rises, the market typically is falling. So can this market sustain rising dollar? All this stuff about the U.S. economy is the only place that's working, and that's why our dollar is going up, and where else are you going to invest? That may keep the market afloat. But we'll talk later about some of those instruments that might be having some issues related to a rising dollar. Market themes, the bull case. I'm not a bull this week. Market resilience despite flow of bad news. Easing in the EU. Falling oil and gasoline equals a tax break essentially to the masses. That might help retail in an otherwise good environment, which I'm not sure we're in. Interest rates remain low, but now we're talking about when they go up, and the strength of the major indices on longer-term charts, such as weekly, which we'll look at. The bear case, rising dollar. Oil is down, lowest it's been in months, which is good for some, bad if you own oil stocks. Gold and silver are down. A prolonged rise in the dollar will certainly hurt those companies that do substantial international business, especially as a rising dollar will lead to higher cost of their goods sold in foreign currency. We have a Fed meeting this week. Now, I suspect it's a 2-day and a report on Wednesday, but I'm not certain. Haven't done my research. But that would tell me that we might have some wildness, volatility in the market this week. It's also quarterly witching, if I'm correct, on Friday, Thursday and Friday, depending on what type of option. And we'll get a report either Wednesday or Thursday from the Fed after their meeting. I think there's a lot of people that are expecting to hear more bearish tone about when they're going to rise the rates, or not necessarily bearish on rates, but more zeal that rates rises might be coming sooner, which is bearish for the market. They've already telegraphed nicely that QE is leaving in October, and as I demonstrated with the graph last week, the last 2 times QE has gone out of the market, there's been 12 to 16% corrections. And the impact of rising rates on markets may give us the correction we have been looking for. This week, trade the market. We have nothing we think we have. That's what I always say. My signals suggest a more bearish stance this week. In fact, I went more bearish last week, early in the week. That means for me, bearish ETFs. I've got puts on the Qs, naked puts on the Qs. I've bought a number of direction ETFs to the downside, SOXS, TZA. I have puts on a number of speculative stock plays, stocks that I think are way overpriced. I have protective puts on a number of my larger long-term positions that I didn't want to take cash on. What I typically do in the protective put perspective is once the market makes a move, I do a response and I try and generate premium through selling calls against the stock or deeper in the money puts against the put to recoup whatever premium expense I have. And then something that I've talked about also in the past is I'm going to predict a 5% impact on my portfolio, and I put on an OEX put spread. I think it's an 885, 840, that with enough contracts that will protect 5% of my trading portfolio. Protect me if we get a 5% pullback in my trading portfolio. From my bottoms-up review this week, recent leaders under pressure include energy and biotech, rising dollar driving down further the price of gold and silver and oil. Interest rate plays this week pulled back, so rising rates may hurt REITs, utilities, and MLPs. There were things that were attractive: transports, trucks, planes, and trains, solar, and banks. Upcoming meetings. Once again, and I appreciate the gentleman from Toronto emailed me earlier today. There is October 12th and 13th. And by the way, please check your dates. I'm not perfect on dates. There's a John Person seminar here in Singer Island, Florida, which is paradise. I live next door practically to the hotel, share the beach. And it is October 12th and 13th. Email me. I can give you more information. For those that follow me, I'm going to hold a 1-day seminar as a prequel on October 11th. Depending on the numbers, it will be 8 to 12 people, and it will be at a modest price to cover cost of room and refreshments. October 3rd for 5th, probably sold out already, the George Lee Advanced Seminar in Orange County. Not sold out yet is Ian and Ron's October 20th to 22nd meeting in PV. I highly recommend that meeting. And once I get through this October meeting and my vacation to Australia, I will get back to you about more information about my February 2015 summit in Singer Island, which will be the first weekend of February, which is going to be a great time. And also, as I mentioned last week, I have a meetup group that I have in the Singer Island, West Palm area. The first meeting will be October 2nd. Keep an eye on seasonality. As I mentioned, this is known to be a tough period of time in the market. This is just looking at some major ETFs that I ran today based upon Friday close, and just looking to see what's up, what's down over the next month. And the first thing you notice is there's only 4 ETFs, China, gold, Europe, and retail, which more years than not have been up, and no more than 3% on China over the next month. And this is looking at as many ETF years as we have, 7, 9, 10, 11, depending on the ETF. Most of the ETFs in the marketplace have been down. You can see utilities, global real estate, which are a lot of the REITs on the downside. Yes, not surprising. It looks just like what I saw today, and my bottom's up with the REITs under pressure. So historically, this is not a great time in the market. Week ahead, FOMC rate decision is on the 17th, which is Wednesday. So that must be when they give a, hopefully, I think they'll talk. I'm not sure if they talk this meeting or not. We get some claims on Thursday. Got some energy numbers, mortgage numbers, and PPI and CPI, which historically mattered, but right now have not been market movers over the last several years. And as you could see, Adobe here, I think that's Apogee, Cracker Barrel, FedEx, Lennar. Not a whole lot of important market moving earnings announcements this week, but if you have one of those, they might be portfolio moving. Now let's take a look at what we can see on the charts about what this week's market may bring us. Let's go into my review from last week. So as you know, I like to see where we came from, what's working, what's not working. Within HGSI, there's this great tool called the Group Performance Analysis. So I track a number of groups. Some of the groups are things that I own or I'm looking at owning. But what it's really doing is giving me an idea of what's working and what's not working. So the first thing we notice is that we only have a few groups to the upside and a lot of groups to the downside. Then I look at where's the S&P 500, and the S&P 500 was down a little bit over 1%. The Market Smith 250 growth was down a little bit over 1%. Our top 30 group inclusion filter was down 1.3. The HGS 100 down 1.6. The IBD 50 down 1.79. And if I had taken my buy list, which includes stocks that are beaten up that I'm looking for signals on, I would have been down 2.5%. So clearly the stocks that we buy had a lousy week. Now, since I've got a lot of short positions now working in the market, I was down less than 0.5%. Now, reality is this is only looking at what I had in the market a week ago, and what I ended this week is very different. But had I kept the stocks, I would have been down 0.48%. Why is that important to me? Because I'm not underperforming, I'm actually outperforming the market. What was working? Breakouts. This is a bearish search. This is something that Ian gave us years ago, blog filter, another bearish search. This is a bullish search. Squeezing stocks from Robert Minkowski, something I put together off of his teachings years ago. Estimate beaters. So there were some that were up there, but bottom line is this was a tough week to make money on. Now that's a Friday to Friday look. I can also do it Monday to Monday, and I can tell you right now there's not a big difference. The Hindenburg omen is a signal that may fire preceding a market correction. Over the last 50 years, you've not had one without the Hindenburg firing. A single or even a couple are meaningless. You're looking for a series of them, but even the first one, I won't say they're meaningless, can be meaningless. 25% are meaningful. When I start to see a shower of Hindis, I get nervous. You could see we don't have a black bar here. We need to have new highs and new lows over 2.2% each. A rising moving average, McClellan less than 0, and the new highs cannot be more than 2 times the new lows. Our problem now is we don't have more than 2% new highs and new lows. So no Hindenburg fired, but I think you felt what happens at market tops where you had good days and bad days, big moves one day, opposite move the next day, some sectors coming in, some sectors coming out. Feels like a top in many ways. From a bucketology perspective, we now have 18% of the stocks in the S&P 1500 trading below the lower Bollinger Band, the 60% below the midline. Now that 18% is significant and could suggest that we have a couple days of a bounce before we continue down. That said, if you go back to July 31st, which was a bottom in the market, you had 35% of stocks, 35% of S&P 1500 were below the lower boundary. If you look for a top this time, we really didn't see one. I mean, this was August 19th. We had about 12%. This is what a top looks like, 18% above from July 3rd. So I look at this number here, and I think we've got too much green, and that I don't believe that's enough for me to say we correct within the next 2 or 3 days to the upside. Why do I say that? Here is a view of the S&P 1500 that I've done multiple times, showing you with these deep pullbacks, when we get to this oversold scenario, we typically bounce. And although the 18% is interesting, when you look at the numbers that we have on some of these, you see a lot of them are closer to 30 or 35%. So interesting, not sure that this signals anything. Now here's your shot across the bow. This is the Woody indicator. What we really are looking for are periods of sustained green or red. Red is time to be short, green to be long. Yellow is chop, and when it goes back and forth, it's hard to make money. But these are kahunas on the major market indexes, and we saw a number of kahunas come in on Friday. When we have seen this before, it usually trips us on the Woody indicator to go to a sell signal. You could have a false alarm, as we sort of had here, where it took several more weeks for the market to ultimately roll over. But typically, when you see this line of red, it's at least a shot across the bow to make us be concerned. Now, from a market stock selection perspective, we have a number of built-in scans in EdgeRadar that can look, for example, at George Lee signals. So this is a down week. You might be looking at those stocks that are, giving signals in a squeeze to the downside. This would be daily or weekly. These are some signals I was looking to the upside. Not a lot to the upside, to be honest with you, this week. Code Blue is a scan that we do using Guillermo Morales and Chris Catchers. You could see that the Code Blue stocks with the kahunas go down about 35 minus this 5 introductory stuff. So that's about 30 stocks. If I look at Code Red, which would be bearish stocks, they go all the way down to 271. So that means we've got about 30 bullish and about 240 bearish. That should also give you an idea of the market short-term direction. Seasonality stocks, looking at 1 month performance from today, are there any seasonality standouts? The answer is yes. A couple of things that I saw here. I saw that Cal Amp is up an average of 15% over the next month, and it's been up 11 out of 12 years. Now, I don't know much about Cal Amp, so I may look at it later on. But when you see something like that, that's a pretty strong indicator that you might see a bounce coming in that stock. Now, we'll make sure we look at Camp later in HGSI. Nike, well, shoemakers have been on a fire, up 10 out of 12 years, 6%. Tyler Technologies, 10 out of 12 years, 5%. This is a bank, and international and U.S. banks were extremely strong this week. They may be benefactors of the U.S. dollar. So this guy's up an average of 13%, 10 out of 12 years up. BAP Credit Corp up 4%, 10 out of 12 years. HDFC up 7%, 10 out of 12 years. So I think there's something going on with banks with strong seasonality. We already looked at the ETF seasonality, so not a whole lot to say here, but I could also look and include countries and get an idea of which countries are strong during this period of time or week. And then I've created with Chris White, not yet for distribution or for sale, more for Jeffrey, my internal use, tools where I can scan the market for John's pivots and changes. This is independent of John, although I am working with John as friends and to see if this is something that we might want to expand to other users. Right now it's only available for me, but it's a spreadsheet and people can develop their own spreadsheets. But basically, I ran and scanned. And here I'm scanning for low close dojis. So these are bearish scans, and we might want to look at some of these later on, such as Hess Corporation. So let me write down camp for the long side from some of these scans. And then on the short side, let's see if I got something that has a low close doji during a monthly pivot. WellCare Group, that might be something that's interesting. I'll look at Red Hat as well because it's got low close dojis. And where's my Red Hat? Hello. And it's sitting right on monthly, weekly, and daily pivot support. If you don't know what I'm talking about, then you need to read John's books, or even better, come to our John's meeting. John is a lot like us HGSI users in philosophy. He's top down. He spends a lot of time looking at the market. He has his tools for sector rotation. He adds seasonality to it and then looks for trading signals in those strong sectors by looking at his dojis and his pivot moving averages. And I've learned a lot from John, and I'm thrilled that I'll be speaking at his meeting and introducing HGSI to some of his audience while we introduce some of our audience to John Person. I also like to look at my elder indicators on the major moving averages very quickly to get an idea if we have any signals there. So I'm looking for colors: blue on the daily, on the NASDAQ, blue on the weekly, blue on the monthly. We got lots of red dots on the weekly, which is MACD divergence. So blue means you are not getting a signal that says to buy or to not sell or not buy. You're getting a signal that says you can make your own decisions, and it should not be. And as I think Alex says, sometimes the buying and selling window are both open. The Dow Jones Industrials, I have a red, a blue, and another blue. So I look at this, and when I see a red daily on the Dow, it tells me the Dow is clearly under pressure and that I'm not going to go long Dow stocks on a red signal of the Dow. So there is evidence of market erosion on the Dow. If I look at semiconductors, for example, red here, part of why I went SOXS, short semiconductor ETF this week, or I went long a contra ETF for semis this week. Look at the S&P 500. All my accounts are different. Which one? Let's see. Here's the S&P. S&P is red. And let's see if we got the Russell on this. TradeStation is kind of funny about what, and we'll take a look at the Russell as well. So I see a lot of red on my elder indicators. You can see the Russell, red, blue, and blue. So my first feeling is I see nothing on this that makes me want to go long anything this week. And rather, what I spent most of my weekend was looking to see what I need to sell, what I need to protect, and if this market continues down, what is it that I can do to protect my portfolio. As you can see, this is the OEX, and you can see it's starting to roll over as well. All right, so bearish stance of the market. Now let's take a look at HGSI and try and explain more of why I'm feeling how I'm feeling. I changed my resolution, which is why everything doesn't seem to fit. So I'm going to go down to Woodward and Brown user groups. I'm going to go into Major Markets Plus. I'm going to go to the T1, which is a balanced over several weeks, but heavily weighted the last day and the last 5 days. Raw combo rank, and the leader is transports. But it's never nice when the next two are volatility and dollar. That tells you that your stocks are under pressure. Mid caps, small caps, gold, utilities, treasury bonds, all sitting down here at the bottom. So no surprise if you feel like you got hurt this week. If you're a stock person without any protection, you did get hurt. 5-day movement, 10% up on volatility, 0.6 on the dollar, Everything else was to the downside. Utilities down 3.3, gold and silver down about 3, and small stocks, the Russell 2000 was down a little bit less than 1%. One-day performance, just looking at Friday, again, the volatility was the leader, and the utilities, semiconductors, bonds, and small caps all down more than 1%. So this is a market at minimum under pressure. It may be a lot more than that. So we'll start with the S&P 500. And, all right. Yeah, my resolution that I typically use is a lot higher. So everything, when you get the lower resolution, looks way too big. Then it looks too scrunched, so let's open it up. So let's start with my, as you can see, we did have a kahuna on the S&P to the downside. That was in that Woody indicator. We had that line of kahunas, so that's not a surprise. Let's go to a simple moving average chart. So magenta is 8-day exponential. The rest are simple. The green is 17. The blue is 50. The red is 200. As you could see, there are 4 red lines of targets that I came up with last week. My first target was to break through the 17 and 8, and you can see it did that on Friday. My second target was about where I thought the 50-day moving average was. That's the next target. This was the most recent low in August, and then down here to the 200. So I'm not sure I change any of those targets in my mind as to where this market is going. Here is the bull case. This is 2009. This is where we are today. And we are in a major bull. From the time that this bull started, at least close enough for hand grenades, this market is up in the neighborhood of 195%. Okay, that's up about 1.4% for every day traded since the market bottom overall. 1388 periods traded, or 0.1%, I'm sorry, and 195% return. That's unbelievable. Okay, so there's no way you could say that this has not been a rip-roaring bull. If I pull this in a little bit and look at this chart over the last essentially 18 months, strong uptrend, never violating the 200-day moving average, short snapbacks below the 50, and recoveries. So hard to be a bear when you see that. So why am I bearish today? I'm bearish today because I think that I gave you a lot of the ideas. I'll let the market tell me what it's going to do. The market's certainly not going to listen to Jeff Scott because Jeff Scott thinks he's bearish. But I think that this, maybe we should expect at least a pullback below the 50. But one of these days we're going to go visit the 200. I don't know when it's going to happen. The last time it happened was in November of 2012. Typically it happens on an annual basis, and this Fed meeting this week, the end of easing in October, and the bearish talk about rates rising sooner could be enough to put us through. That's the S&P 500. Similarly, if I look at, for example, the Dow Jones Industrials. Now we know it looks a little worse because we saw that it was already red, and you could see it's broken down and pulled back almost to that 50-day moving average last week. So that's my first line of support, a break below the 50. We might be doing this again and pulling back to the 200. A pullback to the 200 from where we are from the max, from the high intraday, would be only about a 4% pullback. A pullback, which is nothing, to about 15,460, which is about a 10% pullback. Again, not out of the question. I think a pullback to the 200 at some point, and maybe this time, is relatively inevitable. Looking at the NASDAQ, looks great. Kind of looks like LLURs, except it has broken down. Let's see if it's closed below the 17. It closed at 45.67, and this it's 0.00, so it's less than a point above the 17-day. The 50 is at 44.72, so that's about a 90-point NASDAQ correction to pull back down to the 50, and I think that's the least expensive and most likely correction we're going to see. Maybe not this time, maybe I'm too bearish, but we'll see. Russell 2000 does not look nearly as healthy, and you could see it's had trouble staying above its confluence of moving averages here, and it's pulled back, touched the 50 a couple of times. Needs to bounce soon. If it gets below that 200, I think we're in a lot of potential hurt on the Russell 2000. If I look at the VIX, VIX is trying hard to get back up above that 200-day moving average. It runs up quickly, it lasts up there a couple days, and it pulls back fiercely. It's during these pullbacks that we who are long in the market or want to be long make money. But rising VIX is bad for the bulls, and I think that if you look at a more historical picture, let's look at monthly, we are at historical lows, and when you're at historical lows, you're more likely to go up, I think. And again, if you look at the monthly chart and you look at the monthly 200 average, it fails at that point every time. But that would be a pretty big move in the VIX to even get up to that. Again, that would be bad for stocks. I'm trying not to be overly bearish, but I think that there's a lot of concern. The dollar also not healthy for stocks. Rising dollar, I think, is bad for the U.S. market. And we've had a gigantic rise. Now, for quite some time, frankly, we couldn't get above. This is August 13th when we dropped below the 200. And then we failed at the 200 in June this year. We broke above it, pulled back a little bit. But this was a stock, you'd be very happy. So the dollar is in a very, I think it's strong, and I think it will have impact beyond the metals and is a problem for the market, perhaps to take out recent highs in the short term. Gold and silver are weak, as you'd expect with the Dow, with the dollar being strong. Here's silver and gold actually perform worse for the week. Now, could be setting up sort of a Morningstar scenario there. Sure, it could be. But right now, with the dollar strength, I'd like to see the dollar weaken before I get that excited about gold or silver. One thing I'd like to look at from time to time are market internals. So very quickly, let's pull up the S&P 1500. The reason why I go to major market, they changed this on me. Okay. Let me see what works on this one. All right, broad market indices. The reason why I'm selecting this, and hopefully this is going to work, is because it's calculated from the stocks, and it has it has volume. So the first view is kind of giving me a sense of what the S&P 1500 is doing. The weekly and the daily bongos are red, as are the force index. The green on directional ADX is crossed below the red, which is bearish. And so we have a market clearly under pressure. If I look at the new highs, new lows, we had continue to have the new highs over more than new lows. Our green, which is greater than 65. Well, it's less than 65 and greater than 0. I'm sorry. Dark green would be when it's greater than 65. So we still have more new highs and new lows within the S&P 1500. We haven't had a bingo, eureka, or phoenix. Now let me change the calculation here to make sure I got the NASDAQ for the calculation on the eureka. Let me change these real quick and see if I can make it different. This is something that we did a while ago, and we changed it because of the makeup of the NYSE includes so many bond funds and things that might be behaving out of step with the rest of the market. You can see we did have a couple eurekas here. All right, not a whole lot to be seen there. Accumulation distribution, A's down, E's up, no shocker there. Let's look at number of stocks that compared to their moving averages. These are stocks above the 20. above the 30, above the 50, and above the 200. All of them are down below the respective moving average. When it gets stretched, as it was back here, and it's starting to get stretched there, you might see a market bounce from there. So that could be something saying that we might expect a short-term bounce. 5-to-1 down days, we had one here. Looks like this was probably Tuesday. And from a 10-to-1 day, did not have any. And these both 5-to-1 and 10-to-1 are looking at advances, decliners, both in issues and volumes, looking for evidence of a major movement. All right, that's enough. Back to HGSI. So hopefully I'm not scaring you, but hopefully you see why I think this is a market at minimum is under pressure. And even though I think in IBD we may have reset the distribution day count, I think that this is a market that it pays to be safe. I might be early, I might be wrong, but I feel good having some insurance on my positions. I want to sleep at night and not, rule number one, I want to protect capital. Let's go down to the major industry groups, which we now know are 177 or 178. I take out the industry group that contains all the major industries in them, and so thus I have 177. And then I go and I look at my 2-day up, and I see that 19 of them are up over 2 days. Now I have concern that a 2-day force as a way of ranking industry group rotation is way too fast, and a 13-day force is way too slow. So like Goldilocks and the Three Bears, I had I had the proprietor of HGSI make me a 5-day force. And as you can see, a few more things are actually floating up to the top here. So I'm not ready to sign up only for the 5-day force, but it makes a lot more sense to me, and we'll be taking a look at that over time. So 19 groups are up, and 44 groups are down. More reason to be concerned. So very quickly, let's look at what's up and take a look at some of them. E-commerce discretionary index. eBay is, all right. I do this frequently to help people that are new to me, so I'm going to do it right now. I'm going to build my chart one at a time. Here's my moving averages we talked about before. Forget the orange one. In fact, let me go up here. Here we go. Now I have an 8-day magenta, 17, which is the exponential 8-day, and then I have 17 in green, 50 in blue, and 200 in red, simple moving averages. That's my basic format. I then add certain things to them. I add to them my squeeze and my MOBO breakdowns and breakouts. I add to them pocket pivots, down in red, up in blue. I add my bongos, my force index up here, my high jump, viable gap ups as well. Down here I have my kahunas, and on the higher one I have the phoenixes and eurekas, which we don't see any there. And then I clean it up and bring it down here, and I'm playing around now looking at high closed dojis and low closed dojis and other things, but let's go into my regular nuclear scan. So bongos, third one is accumulation distribution, and then force. On both the bongos and the force, the long term is on top, the short term is on weak. On the high jump bar, I'm looking for how extended the stock is, and I want to compare it to the previous high. Here was a high jump near the top of the bar, and the market sold off. Here was probably a high jump, and the market sold off. So I look for evidence that the market is overly stretched, extended. I'm not doing much with the DMI now, so let me hide that. The next one down is Bible gap ups in green. Followed by my squeeze, my mobile breakouts. These dots are PSAR, and this heavy line here is industry group. You don't have to have as crazy a chart as I do, but it's something that I like. So here's eBay. I'd made money on eBay on the way up. It had a fairly hard sell-off. Group is still strong. It's not anywhere at the top of the high jump. It had a green candle low here on Friday, lowest low in 10 days back, closed above the open, so it's green. It had a kahuna. You know, it's still pretty beaten up. It's below the 200-day moving average. I would pass, but I would probably keep an eye on it. Don't know Net Element. It's a cheap stock. It had a Bible gap up, broke above $5. Now, it's something like this, NETE. I might, you can see right now the futures are under pressure. I might go into MarketSmith and see if it's got any more information. It's probably a smaller stock, so we'll see if there's any information. So why MarketSmith versus HGSI? It gives me additional years of earnings, which it doesn't have any. I see how little it makes. Integrated mobile payments in Russia, US as well. Sold off for a long time. Massive volume came into it. Sure, it's a great stock. It's just not the kind of stock that I buy, so I'm going to pass on that one. It's cheap, and the volume is, it's got 1 million shares a day. Too cheap, and I don't understand the industry. Next one is Land's End. This is an internet retailer. Something is going on here. Look at this earnings per share growth. This must have been a company that was taken private and then re-IPO'd. Let's take a quick look and see if there's anything on MarketSmith that I should be interested in. $2.70 earnings, $2.50 next year, trades at a multiple of 17. 17 times 250 is 25, and then 14, 27, 28. So it's probably a $54, $55 stock if it makes its earnings. Certainly something happened here. If I right-click, I can go to more info from web, go down to FinViz, and if my computer is not unhappy with me, as it's been the last couple of weeks, all right. As long as I got MarketSmith open, it's not going to let me do that, so I'm not going to open it. But I could go into FinViz and see what the news was, but we're going to skip it right now for the essence of time. Zulily, beaten up stock, had a pocket pivot. A kahuna, broke positive OBV. You can see the industry strength mobile breakout coming out of a squeeze. This is a stock that's just been annihilated, and it's showing some life, but it's a bottom fish, and in a tough market, I'm probably going to pass. So I look at this group, and I say, okay, but I'm not that excited. And so I'm going to move on to the next group. Base metals, change the index group. Cheap aluminum play. Now I made some money on Century Aluminum, and Alcoa's been on fire. Negative earnings turning positive, NOR. So quickly go to my MarketSmith, 41 cents in 2015. Give it a 12 PE. So 44.85. You know, it's probably a $6 to $8 stock if it makes its numbers. It's trading at $5.60. Right now the group is strong. Again, it's a cheap stock. I'm going to pass on it. For me, only 845,000 shares passed. I'd rather own Alcoa and CENX if I think this group is going to start to move. Cameco for uranium mines, pass. Kaiser Aluminum, not a pass. This is one that I find very interesting. Run up sideways. It's below the PSAR. It's unbalanced volume cross positive. It's basing. I'm going to wait for it to give me a breakout signal, which I don't see yet, but that might be one I place on my watch list. All right. So far, I'm not liking the longs, but that fits the theme of this today. Telecom carriers, Sprint. Don't know why it had this. Maybe it's because of its Wi-Fi calling with iPhone, but you know, it's way below the 200-day moving average, which means it's bottom fishing, but it's put in around a bottom. It broke above the 50 here. On-balance volume is moving up quickly. Its technicals are turning green. It had a number of kahunas over the last 5 or 6 trading days. PSAR support. Does not pay a dividend. Again, I don't like buying things that are this far below the 200. This one at least looks interesting. 21 Vianet, that's a bingo. That's a sign of a market trash. And we don't buy stocks that are in the midst of a bingo. GoGo Internet on the plains. Stirring here. I'll pass this below the 200. T-Mobile, a little bit nicer pattern and a nice move up here. It too is below its 200 and its 50, despite the fact it's had a number of pocket pivots. I do like how its on-balance volume is leading it up, and there's some M&A discussion, which is probably what's driving this. Truth be told, I did buy some calls on it 2 weeks ago. A little bit out of the money. They were cheap just because of the merger and acquisition talk. So I don't see anything there that I like. So that's 3 groups down. Advertising and marketing, Conversant. Again, there's been more M&A discussion about who's buying who. And Conversant on M&A speculation had pocket pivots, a kahuna, and a big bounce on Friday. It's gone. Probably not anything I'm looking at now. Alliance Data System is below the 200. Criteo is another one that has been discussed as a potential acquisition candidate. The problem with these stocks, CRTO, you're not buying them because of great numbers, although here's Criteo. It's set to make 50 cents this year and nearly $1 in 2015. It's not a cheap stock. It trades at a multiple of about 50, but at least it has a growth rate that might support it. This might be one to take a look at, breaking above the 200 here, and I think we talked about it. No, that's the 200. That's not one of my lines. And then that's the index. So maybe that's one that's interesting looking. Just we're not finding a lot of great stocks. Coal, well, that's been a bullish area. One stock above the index, not a very bullish sign there. We'd like to see several stocks above the index. And you could see this is a play that woke up here and, kind of wedging forming here. Doesn't make money. Coal's been in a serious bear market, which I don't see that changing until we have a new president. Let's take a look at daily graphs if there's a reason for this. SCOK. I don't see anything here. Chinese producer coal and coke. Not stocks that I want to play. And I don't look below the index. Other retail discretionary. Alta had some good earnings. Most of these are either being pulled up by Alta or have some M&A. So shooting star, but it did have a good week, a good day on Friday. Mobile breakout from a squeeze, a viable gap up, pocket pivot, and kahuna, all the things that we like to see to get excited. But it's already had a big pop. Staples, some talk about Office Depot and Staples coming together, or Office Max and Staples. I think one's already been acquired, and that the FTC might allow it to happen. And so got above its 200, held. This might be something to look to start to accumulate. Don't like its earnings per share growth. Don't like the fact it's 200-day moving is down trending. Do like the industry group's score. Office Depot, maybe even more interesting because of the earnings per share growth. Sort of a cup, a handle, and a breakout, positive on-balance volume. This is probably the acquisition candidate of Staples. Sally Beauty, probably bounced on Ultima numbers as it's a competitor, but pull back to the 200 and bounce. PSAR is supportive, everything is green. Pocket pivots and kahunas, makes money. Might be an interesting thing to look at, especially with the way Alta beat its numbers. Next one down, renewable energy. You notice, well, one thing, it's biofuels, but GPRE and PEIX got hammered this week. Might be something to put on your watch list to see if they bounce. Solar, I said, was strong. Here's your proof. Solar City, don't like the earnings. Look at the 5.6% move this week. Broke out on Friday above its PSAR earlier in the week. Everything is green. Mobile breakouts and a squeeze on Wednesday. Pocket pivots and kahunas, very attractive. Don't like the numbers, like the picture here. Here's Trina Solar, deep pullback, breaking out. I have a position this, everything is green. Look how strong the OBV has been, going back now over a month. Here's CSIQ. This is one that I talked about in June, loving its earnings growth. And finally, it made me look good, breaking out. We'll see if it can retest prior highs in the mid-40s. JA Solar, again, getting above the 200. So when I look at these, Trina Solar and JA Solar are probably lower risk. Canadian Solar is getting up near prior resistance, and Solar City's got the pretty chart without having a whole lot of earnings per share growth in the short term. Back. So I like the solar, as I said. Household products. And whenever you see these, you know it's not a great time in the market. Why are these here? Because these are mattress stuffers that pay dividends, 2.2% on Colgate. I don't see anything here that I like. And here's the index, Hong Kong High Power. I'm not even sure why it's HPJ, because it sells products. HPJ. This was a high flyer that was talked about on several boards that I participate on. And 40 cents, 100% growth rate. So is this a $10 or $12 stock? Absolutely, based upon these numbers. Now, if you believe these numbers, that's something that you have to decide on. So you got a deep cup, pull back. I mean, setting up perhaps to break out to go to higher highs. You have everything is green. I don't think I had this originally on my watch list, but I'm putting it on my watch list. HPJ. Avon, below the 200. I'm going to skip that and go to the next one. Ninth, apparel footwear. Retail's been weak, except if they're footwear. I remember when Under Armour came out with great numbers and blamed it on footwear. So very quickly, Michael Kors has been under pressure. Perhaps it's found a bottom and maybe trying to move. It's too early for my taste. VF Corp, North Face, and others. Looks like it wants to break out and go higher. This is post a split. Everything is green. Mobile breakout, pocket pivots and kahunas. Nice OBV. Deckers is a shoe company. Uggs, and shoes are strong. It wants hard to be a $100 stock, which it'll probably get this week. PVH apparently does shoes too, and broke out on earnings here. A little bit of a flag there. Vera Bradley, I thought they make fancy suitcases, but they must have a whole line, including shoes. Below the 200, I'd like to see it get above the 200 and hold. Skechers, this is the one I want to look at. This is probably one of the tightest and nicest charts in the market right now, and I didn't take this here. I am so pissed at myself. Mobo breakout from a squeeze with pocket pivots and kahunas at $39, and it's gone up about 80% since April when it made that move. Did the same move here with earnings, and just footwear sales are strong in retail right now. Cable and satellite index. Not sure what's at play here. Interest rates going up. I mean, some of these are dividend payers. I look at this, I see a sideways market. I'm not too interested. This is Liberty A, Liberty B, or Liberty Global. Doesn't look that exciting. Comcast, well, it looks a lot nicer. At least it's in a nice uptrend. Multiple pocket pivots, strong on balance volume. Pays a 1.6% dividend. I'm pissed at them because I got problems with my TV today. And I hate when, no disrespect to anybody from India, but I kind of prefer having a U.S. Person helping me. It's just, maybe I'm racist, biased. I don't care where they're from. I just prefer somebody who speaks English with our as a first language from the U.S. But that's bygones, and I probably shouldn't be saying things like that when I'm taping things. Time Warner Cable, trend is up, multiple pocket pivots, 1.9% dividend. There's been some M&A discussions in this sector too. I always get nervous unless I understand the sector. Just looking at what else is strong, I mentioned banks. So this is just ranking by raw combo. So let's just go through very quickly. Comerica, sideways bank, looks like it's breaking out here. Mobile breakout, everything's green. Pocket pivot, Kahuna breaking above OBV, that's on my buy list. Regions Financial, breaking above the 200. Similar picture, perhaps not as strong on the technical signals. Huntington Bank shares, already in an uptrend, breaking out again with the Kahuna. Everything is green like this one. Fifth Third, below the 200, I'm going to skip it. U.S. Bank Corp. Here's what I like, T-Core. Looks like it's breaking out. Pocket pivots and Kahuna is mostly green above. There's lots to like on the banks, and it's not just the little banks. How about Bank of America? Multiple pocket pivots, everything is green, breaking out. This is a stock that, perhaps now that some of its government concerns and fines are out of the way, can start to go back up on its trajectory. Up until April this year, this was in a nice bull run since middle 2012. Here's our cup. I think we're getting ready to break out on Bank of America, and I'm just thinking perhaps that the banks will benefit from a rising dollar and interest rates. All right. Let's see to the downside. Everything. Oil, gas, and exploration, and services. Biotech got hammered this week. Utility networks, they're rising rates. It costs them more money to play. I thought we'd see more REITs here, but several of these lodging indexes are REITs, as are some of the facilities here are REITs. So REITs have been tough. Generics, it's just been a tough couple of weeks in the market. Home builders also hurt. Let's go back here just out of curiosity and see what, if anything, the top 10 changed by looking at a 5-day. Banks moved up in the top 10, but pretty much no major difference. All right, so if I was to stop right now, and we're getting close to stopping, I would say market under pressure, and you need to be protecting yourself. And I don't think I had one thing that I put the hammer down and said, you need to buy this. I often look at all stocks, run a couple of scans. My 5 times type filter, China Green Agriculture, that net element we looked at, Alta we looked at, Conversant we looked at, Nora we looked at. A couple things here that looked interesting to me. Let's just put CGA because it had massive volume and closed up 25%. Typically, massive volume is followed by more volume and more up. Now this one closed at the bottom of its trade. Mobile breakout from a squeeze. Still had a great day. It was up 25%. At what point it was probably up 100%. Don't see much here in the way of earnings, so let's go into our trusty MarketSmith. Don't see much of earnings there. I mean, obviously the target would be to get back to this September 2013 $5.10 high, which would be nearly a double from here. Too speculative for me, so I'm probably not going to play. This is one I don't know anything about, but I'm tempted. I don't like the fact that it closed near the gap, but I do like the fact that you had multiple kahunas over the last couple of days in a stock that's been a downtrend ever since the IPO. Mostly green up here. Mobile breakout from a squeeze on Thursday. OBV spiked. I might set a buy stop somewhere around 7. If this thing goes up, I might want to play that. I also look at 3 times volume, adds a couple. So I look at volume to see winners. I have a scan that looks for stocks that are right below the PSAR dot. I love this scan because instead of finding things that are already broken out, it finds things that are about to break out. So for example, and to make this simple, there's not much on this chart. So this is looking for stocks that are squeezing. that are right below the red PSA R dot. The squeeze tells me that it's somewhat basing, and I can set a buy stop a little bit above that red dot and know that if the market opens and trades up and this takes out the red dot, that I go long. But if the market sells off and I never take out my stop, then I don't enter this trade. I'd also put my stop probably not much below the 200-day moving average. So not saying I'm buying PRAA, but I'm looking for stocks that close within 1% of their PSAR dot. Here's Sun Financial, up, sideways, little ways to go to the PSAR dot. Kaiser Aluminum we already looked at, right below that PSAR dot. There are people who have a trading system that's purely you go long when the dot's below and you sell when the dot's above, and these become your stops. So I use them similarly, but I use them as a trigger. Here's UPS. This one I probably like the most. It's in a nice uptrend, going sideways, supported by the 17. There's no overhead supply in a squeeze. A takeout of its PSAR would be very bullish for MKS Instruments. Royal Bank of Canada going sideways, the same picture. Now I have a similar scan that I use find stocks to potentially short. So these should be stocks that are going sideways, that have a squeeze on, and are just above the green dot. This is too short-term traded. Whole Foods already beaten up. All right, so here's one gas. Here's a stock that's gone sideways now since March. Broke below its 200-day moving average. There's no moving average sitting underneath for support. It's probably a new issue because there's no 200-day moving average at all. Had a MOBO breakdown from a squeeze. A break below this PSAR dot will put the dot up above it, and that could be a short signal. Don't know anything about it. Google, sideways on the 50, breaking down here. Breaks, takes this dot out, might be a shorting candidate. Cooper Companies, more attractive potential short if this market rolls over. It's rolling over at the 50. It takes out its PSAR dot and moves below the 50. This might be a shorting candidate, and you could put your stop probably kind of close to where that 17-day moving average is. Colfax, again, it's already broken below 200, moved up, perhaps getting ready for potential shorting it again. So I'm looking for stocks that are telling me they might be at a good time for short, and by definition, all of these stocks are squeezing and they close right above that PSAR dot. All right, what else do I like to do? I have my favorite other scans such as sprinters, and then I like to do the group inclusion report. Ron spends a lot of time on that, so rather than look at how I did it, let's take a look at the stocks that I came up with on this week's GIF, and let's go through those top 30 and then I'll look at one other thing that I wanted to do and then say goodnight. So I'm going to go very quickly through my top 30 group inclusion report. What do I do here? So I gotta take everything off here. There you go. All right, very quickly. XPO also is on my buy list. Logistics support, Bible gap up on Friday, huge volume. I assume it's a Bible gap up. Let's go to my secret weapon chart. Bible gap up on Friday, everything is green, strong OBV. I wish I was already in this one. I'm going to take a look at this. There's others in its group. Earnings are not so hot. Canadian Solar, we've already talked about. I am in this one, big earnings driver. Right below the PSAR dot, could be giving another buying opportunity. Had a pocket pivot on Friday. Skeechers, we already looked at it. Tight, lower left, upper right, driven by shoes. Office Depot, M&A issues, we already looked at it. Activist, this is a generic manufacturer. Take a look at the weekly chart. It's been incredibly strong, but frankly, ever since the beginning of this year, it's been going sideways. Sideways while earnings are diminishing, is not something I like to see. I'm less bullish on this now than I was a year ago, but you could still argue 20% earnings per share growth, PE of 19. At 16, it's worth 340. If it hits its numbers, it's trading at 234, so it still has a ways that it can run. I just liked it better when it had the higher earnings per share growth. Rambus, love the chart pattern. Basing, series of pocket pivots and kahunas broke above the 50, mostly green above. Don't like the earnings per share. I'm not sure I love the industry, but the industry has been strong. Alta we looked at already, popped on earnings. Time Warner, talked about already, some of the M&A stuff going on there. Cal-Maine, eggs. It's kind of been a bull market for eggs, hasn't it been? A lower left, upper right. Mobile breakout from a squeeze on Thursday. Do your homework. Interesting looking chart. Don't like the earnings I see there, so let's pop up here. And you can see it makes a ton of money, but it doesn't have much earnings per share growth beyond 16. However, for 2015, $6.15, 18 multiple, growing 36%. If it maintains that multiple, it's $110 stock. So Cal-Maine, eggs are good. Eggs are in fashion. Truckers I mentioned look good. This is ODFL. I also liked Conway. Here's Southwest. I liked Southwest the most. Delta looks like it's ready to pop up as well. Don't know much about XRS, which is part of the TAL Education Group in China, but it's made multiple scans, including my person's high close doji occurring at a major pivot support. I like to see it take out its PSAR. I am not in this one. I'm concerned about the market, so it's tempering my enthusiasm to go new longs. But if the market is strong, I'm going to be looking hard at this one. This is one that's on my buy watch list. International Rectifier is a takeout, so we'll skip it. Net1 UEP is a transaction management company in third world countries. It's a South African country. Must have had some good news this week, but I think it was on earnings. Nice move up. Base for a while, took off. It's had a big run at the high jump, so I'd be a little bit careful. Avigo, big move up on earnings, going sideways. Great earnings per share growth. If this market sees another leg up, this could be a leader. That said, it's had a big run. I love the earnings per share growth, $6.37. Even if it's only $6.30% or $6.23 PE, it's a $120 stock. It's a $90 stock today. This stock will go higher, but it's extended, and this is a market under potential pressure. Gilead shows what happens from that pressure. I took profits on this stock, and I'm dying to get back in. You can see the earnings per share growth opportunity. This is just a really ugly series of candles. This was an ugly day. I'd like to see it get back down there so I could buy some more. Facebook, nice uptrend, looks strong, nothing new to say on Facebook. And Log Me In, like the pattern, pullback, sort of a cup, breaking out, lots of pocket pivots, everything is green. Mobile breakout from a squeeze on Wednesday when it took out a number of multiple moving averages. Short term, some nice earnings coming into the chart. $1.26. So the question is, and this is worrisome for me, at some point, and I'm a technician, so from a technical perspective, if it takes out these tops here, I might be interested in getting in. And you could see this 47 and 60 cents has been resistance on several occasions. But diminishing earnings per share growth, can it sustain this price? I don't know, but since I'm a technical guy, I do what the chart says, but it's going to have to take out these tops before I'd be interested in getting in. It's 3% away. Don't know this thing at all. Seat Partners Executive Search, nice earnings per share growth. Don't know this company from Adam, 110,000 shares. Don't want to know this company from Adam. Gentherm, they make the air conditioning in the seats, lower left, upper right. Series of red candle highs, although it's not at the high jump. Looks like it's getting tired like the rest of the market. Still has great earnings per share growth. Bit Auto sold off this week. Be interesting to see where this one goes. I'm not in this one until it starts to trend again. Is this going to be a new bottom to go from? I think a lot depends on what the market does. MEI had a big move up on earnings, going sideways since. Great earnings per share growth. Everything is green. Skyworks in the same group as Avago and also RFMD, lower left, upper right. A little bit soft up here. Mobile breakdown. Kahuna to the downside, so we might see some pressure on Skyworks. White Wave, I think they make peanuts and stuff. And I also think that this has been under a M&A discussions. Nice move. Don't know enough about this one except it's a red candle high. Salix maybe giving you a better opportunity to buy. I like this company long term. They've got some neat things. They've done a nice acquisition or two along the way. Kind of reminds me a lot of Jazz. It jumped up here when Shire talked about acquiring them, or maybe it was up here as sort of a defense against Valiant. I don't like the recent performance, and I would just watch it right now. Don't know this from Adam, which tells me it's a low volume stock, 100,000 shares. We're going to keep going. Trinity, one of my favorites, same chart as Greenbrier. It's a little bit under pressure. They make the rail cars that have been involved in the fracking and carrying oil back and oil products. Super strong. Right now, I'm a little nervous. I have a big position, and I've got a married put on. VDSI, we know the internet security. Every day you hear about another big company blowing up. VDSI, nice uptrend. It's expensive, doesn't have much in the way of forward-looking earnings here. So let's just take a look very quickly. All right, VDSI. So you can see how I integrate a lot of my programs, and I'm flipping back and forth. So VDSI, big move, 60, 70 cents, 24. I mean, I guess it's potentially a $20 or $21 stock if it can make these numbers going into 2015. And then Ambarella, big move off of earnings, nice looking chart, makes money, semiconductor services. Greenbrier, as I said, just like Trinity, under a little bit of pressure here. And that was the top 30. So let me just show you the stocks that looked interesting to me on my buy watch. Most of these we looked at already. There's that HPJ. Skeechers, some banks, some solars. Valiant, I think, is getting ready to make a move. The airlines we talked about. And then let me look at some of those things I wanted to look at before we said goodbye. Based upon some of my person signals, and I haven't prepped this, so I may say nope. Camp looked bullish, so it should have been a bit of a pullback. So I don't really see a whole lot here except, let's see, on a weekly chart, pretty deep pullback. So down to support here. That's not bad. Here's your high close doji on the weekly chart. Here's the doji closing above it here. Not my type of stock, so I'd probably pass. Does have group strength, a little bit below 200. As a potential negative, WCG came up. Yeah, I mean, here's a stock, earnings, losing earnings, failed at the below the 200, failed here at the 50. Here's your doji, 1, 2, 3, a low close doji occurring here, failing at the 50, a lot of room below, no moving average, no obvious support, maybe down here a little bit. That looks like an interesting stock if I wanted to short the market. That's why you scan. Not everything works. Oh God, I can't read the next one. Red hat. Probably too early to short from my perspective because you got the 50 right underneath, the same as the PSAR dots. But that looks interesting as well, mobile breakdown. So I use these programs to help me find targets to study further. Now lastly, this has got to be my favorite real-time program. So let's just see what I see on CAMP and on WCG here. So what I've got are some of the more traditional indicators we use here. This is a daily chart. This is a 60-minute chart. And then these are person's pivots. And his person pivot, his PPS buy signal and sell signal. And this is a daily chart. This is a weekly chart. This is seasonality. And so you could see that seasonality over the last month for CAMP has been extremely strong. This here is, see, I got quarterly pivot here. Quarterly pivot support is right here. So I've got pivot supports, R1s, R2s, S1s, S2s. And I have the little triangle buy signal and sell signal. I have unbalanced volume, and I've got multiple time frames. So he did have a daily buy signal, a weekly buy signal on CAMP 4 weeks ago, as well as a daily buy signal, the last one on August 19th, which looks like it occurred at the same time. So that's when his signal, and obviously that signal looks pretty good. If I put in WCG, I see on the daily chart, I see a sell signal, but not yet on the weekly chart. But this is one that I would be watching for that weekly sell signal come in. You could see it failing at the 50-day. Other things that I do with this is I scan my universe of stocks. And here I was looking for stocks that gave me a long signal, both daily and weekly, in my universe. So Agilent, daily long, weekly long, strong move during the day, closed at the high. Seasonality is not so good here. On-balance volume is trending up. And this one is one that I'll be looking at later. Lots of scans within this program looking for buy and sell signals. Then I created one called the low jump. And these will be stocks that are getting close to a point where I expect a bounce. But this is not top-down buying strength. This is buying weakness. But no signals there. On that note, I think I'm getting tired. You're getting tired of hearing me, I hope. Look forward to seeing some of you in October. We looked once at the futures, and the futures were ugly. There's no reason to expect that they've changed. I think this is going to be a challenging week, at least until the point that the Fed speaks. And you could see right now the Dow's down 41, NASDAQ's down 10.8, S&P down 6.49. And on that, I hit Shift